Good morning, students. Welcome back to this discussion on accounting standards. So I think there was a part in relation to the consolidation, okay, uh, which we covered, I think, up to associates, right? So we started with the requirement of consolidation of subsidiaries, okay, and then in between you had to cover some other topics. So today we plan to wrap up our the remaining part in relation to the consolidation requirements, okay. So there are a couple of things we need to cover. One, of course, is on the associates briefly, and the other one is on the joint ventures. So what I'll do is I'll just start with the joint ventures. Then, as the time will permit, we'll get on to some of the requirements related to associates as well. Yeah. So now let's quickly try to talk about the joint ventures. Now, what is a joint venture? So, as we understand, joint venture is a venture wherein two or more parties are coming together. Okay, so if two or more parties come together and they enter into a setup, that is what you call as a joint venture. Yes or no? Yeah, that is what you call as a joint venture. Now, in relation to joint venture, let's try to understand some of the very important aspects. So, under what circumstances we can say that the venture is something which will be considered to be in the nature of a joint venture? Okay. So now, the first point, for a venture to be called as a joint venture, there has to be a contractual arrangement. Now, this is, you can say, kind of condition which is attached to this. Okay, so there has to be a contractual arrangement. And in this arrangement, two or more parties should be involved. Okay, so what is the second condition? It has to have at least two parties. Obviously, because when there is a contract, so it will involve at least two parties. Yeah. But is this really limited to two parties? The answer is no. Okay, there can be various parties which are forming part of this contractual arrangement. Third, this venture, which is created by these two parties through a contractual arrangement, should be subject to joint control. Now, this is the most important point, joint control. So, any thoughts from your side? What is the meaning of joint control? Quickly, over to you. Any thoughts quickly? What is the meaning of joint control? Yes. So, how do you define a joint control? Yes, quickly. How do you define a joint control? Joint control is something which will arise when all the parties which are involved in the arrangement, they are taking the decisions on a unanimous basis, which means that any decision which has to be made in respect of the matters in relation to that entity. So how will that decision be made? With the consent of all the venturers. Okay, so that is something which you call as joint control. Means every venturer has got control in respect of the decision making. And please understand that without the existence of this joint control, a venture cannot be considered as the joint control. Okay, now the question arises that what could be those activities, what could be those decisions? Now we are talking about some of the key decisions in relation to an entity. So let's suppose tomorrow if any KMP is required to be appointed, if there are any financial or operating related decisions, okay, any capital budgeting decisions, any expansion plans are there, or if the entity is considering to hive off any of its operations. So these are all critical matters in relation to any entity, or you can say important matters. So therefore, for all of those matters, for all of those requirements, one should have joint control over the decision making. Okay. Now, the other point is contractual arrangement. Now, the standard says that for this joint control, The arrangement between two or more parties should arise through a contract. Okay. Only and only when this contractual arrangement is there, that is when you'll say it's a joint control, otherwise not. And the moment you say it's not a joint control, so what will happen? You will move out of the purview of AS 27. Okay. Yeah. So now the next question could be that what do you mean by contractual arrangement? Now this contractual arrangement could be in any form. For example, there could be a written contract, means an agreement between the parties, or maybe they have agreed on some points for which some minutes have been prepared. Okay, so it could be in the form of minutes of discussions. Okay, or maybe in the articles of association of the company, this has been specified. There are bylaws of the entity in which it's been specified. Yeah, so it can be put together in any form. So it is not necessary that it has to be a legally executed agreement. Only then it will become a joint control, or only then it will become a joint venture. No. Yeah, the important part is that two parties should have an understanding, and they should be clear in terms of how the business is required to be done, how the decision making is required to be looked at. If that is the case, if that understanding is clear, then you'll say that yes, the existence of joint control is there. Okay. Yeah. Now what we can do is we can just look at some of the situations, and in those situations we will try to understand as to what could be the forms of various types of joint ventures. Okay, so again, we are not getting into those technical requirements right now. We'll just look at some of the examples in a way. Okay. All right. So now if you can just move on to these small examples. So we'll try to understand this concept. All right. So let's look at this example. IDBI gave loan to joint venture entity of L&T and Tentia Construction. They signed an agreement according to which IDBI will be informed for all important decisions of the JV entity. This agreement, now there is an agreement between what? L&T and Tentia Construction. Now, when you are saying that there is an agreement which they have executed, now what is the purpose of this agreement? The purpose is very simple. Okay, what is that? The rights or the loan which has been taken from IDBI. Okay, so in such a case, the interest of IDBI should be protected. Okay, in this case, just signing the contractual agreement will not make the investor a venturer. So the question is that in this case, when we are talking about JV of L&T and Tentia, so should IDBI also become a venturer? The answer is no. As regards L&T and Tentia, we don't know. Okay, we have been told it's a joint venture, so we understand. But should IDBI also be considered as the part of the venturers? The answer is no. Okay, so let's look at another example. X Limited invested rupees 200 crores as initial capital along with Y Limited and Z Limited in GFH Limited. Okay, so there are three venturers. Who are they? X, Y, Z. So it seems they have come together. They have invested 200 crore in a company. So they have created a new company. What is that company? GFH Limited. Now, the purpose of X Limited making this investment is to grow the business of GFH Limited along with other investors. Okay. So it appears this investment has come from X and there are other investors as well, Y and Z. And they want to expand the business of GFH. Okay. All the investors have the right to attend to the meetings and to take decisions with regard to business of GFH Limited. All the investors are actively involved in running the business of GFH Limited, and they also have a share in the returns which are generated by GFH in the agreed proportion. Now, what is that agreed proportion? We don't know. Now, in this case, let's try to look at as to whether all the conditions in relation to the joint venture are met or not. So, what is the first condition? There has to be a contractual arrangement. So, do we have a contractual arrangement in this example? Tell me quickly. What do you think? Do we have a contractual arrangement in this example? Over to you quickly. What do you find? Can we say that there's a contractual arrangement in this example? Over to you quickly. Can we say contractual arrangement is there? The answer is yes. Great. So Anil is saying yes, there is a contractual arrangement. And what is the contractual arrangement? So this understanding between the parties about what? That every party will have the right to attend to the meeting, to take the decisions. They will be involved in the decision making. They will share the returns of GFH. So this is all what? This is all about the agreement. Okay. Second condition. Can we say that all the parties X, Y, Z have got joint control? It again seems to be yes. Why? Because it says that all the investors have the right to attend the meeting, and they will be required, they will be involved in the decision making. Okay. Now, that means that if the decisions are required to be taken, they cannot be taken only by X, only by Y, only by Z, or only by X and Y ignoring Z, only by X and Z ignoring Y. Okay. So therefore, in this case, joint control is also established. Yes or no? The moment we have these two conditions fulfilled, what do you call it as? Joint venture. What do you call it as? Joint venture. Okay. Clear on this? Now, in this example, just because the contractual agreement has assigned the role of a manager to any of the venturer, that will not make the venturer or that party as the venturer, or maybe disqualify him from being the venturer. So what does it mean? So let's suppose out of these three parties, it's been agreed that in relation to, say, day-to-day activities, say the work related to operations will be managed by X. Okay. Now in this case, some role and responsibility has been assigned to X. Yes or no? Now in such a case, can we say that just because this role and responsibility of X has been assigned in relation to this entity GFH, therefore X will not be a venture? The answer is no. X will continue to be a venture. Why? Because X is playing that role over and above those requirements which are required to be established in relation to joint venture. And what are those? Two things: contractual arrangement, second, joint control. Okay. So if there is anything other than that, that is required to be accounted for or considered accordingly, that will not change the understanding of the joint control to be in place or to be existing in respect of that venture. Okay. Clear? Any questions so far? Any questions so far? No? All right. So now moving further. Let's take one more example. Mr. A, then Messrs. B and Company, Third, C Limited, they entered into a joint venture. Okay, so they have created a joint venture where, according to the agreement, all the policies making decisions on the financial and operating activities will be taken in a regular meeting attended by them or their representatives. Implementation and execution of these policies will be the responsibility of A. In this case, let's try to understand whether A, B and Company and C Limited. Okay, so there are three parties effectively. Do we have a joint venture in place? See, first of all, the question itself is telling you there is a joint venture. Okay, so we don't need to get into that assessment. But still, if you read one of the sentence, it says all the parties, means all the three parties, they are involved in policy making decisions. If any of the party will not be present, so what will happen? Representative of that party will come. Okay. So for example, if C Limited is not able to attend, so what will happen? Representatives of C Limited will come. Yeah. So even through this understanding, we can say, yes, it's a case of joint venture. But in this situation or in this venture, some additional responsibility has also been assigned to Mr. A. And what is that? There are certain policies which are required to be implemented, which are required to be taken care of by Mr. A. So now in this case, A will play some additional role as regards the operations of the company. But can we say that just because A will play this additional role, therefore the joint control will not exist? Can we say that? Can we say that joint control will not exist? What do you think? Can we say that? The answer is no. Anil says no. What about others? Anil says no. So clearly we can say that this additional role being played by A doesn't impact the existence of joint control. Until the time joint control will remain, so what will happen? We will have to call this venture as a joint venture. Okay? Yeah. So we'll have to call this venture as a joint venture. All right. Clear on this? Everyone clear? Okay. Malu has a question. Yes. So Malu is asking, sir, if one company become a joint venturer, then after we cannot disqualify them. See, it's not that if one of the parties is a party to the venturer. So let me just take up this example. Okay, so let's suppose there are three venturers. Who are they? A, B, and C. Okay, they have created one entity. Let's suppose that is Z Limited. Okay, so initially there were three venturers. Yeah. Now, just because there were three venturers initially who have created a joint venture, what is the name of the joint venture? Z Limited. So, does it mean that this JV will always exist? We don't know. Why? Because JV is what? This is a company. Yeah. So, till the time this company will continue, so we'll say yes. But the point is that will this company be continue to be called as a joint venture? The answer is yes. But for that to be, at least two venturers should exist. Yes or no? So currently, how many venturers do we have? We have A, B, and C. So currently we have three. Yeah. But we need at least two. So let's suppose tomorrow, if C walks out. So if C doesn't want to continue, so is that possible? The answer is yes. In such a case, will C be considered as the venturer anymore? No. If C walks out, so C will not be considered as the venturer. But in such a case, will Z Limited be continue to be called as a JV? Yes, that depends. That will depend on the revised contractual arrangement. Why? Because the initial contractual arrangement will come to an end or will require some changes the moment C will walk out. And who will have the revised contractual arrangement? Either A and B, or if let's suppose in place of C, some new party comes in. Okay, so that's how you are required to always look at it. Understood? Understood. Malu, clear on this? Yeah? Malu, clear? All right, great. Okay, so now moving further. Now, in relation to the joint venture, okay, so far what we have discussed is that under what situation investee, now please understand this Z Limited was what? JV, or you can say the investee. And A, B, C, they are all what? They are also called as venturers. So this is also a venturer. C will also be a venturer. Or you can call them as investor. You can call them as investor. Similarly, B will also be an investor. C will also be an investor. Correct? Yeah. Now, the question is that the investment which A, B, and C had made in Z Limited, we have understood under what situations such an investment can be considered to be a joint venture. For that, we discussed there are two criteria. One, there has to be a contract. Two, through that contract, there should be a joint control amongst all the investors. Okay, there should be a joint control amongst all the investors. Okay, now these JVs or these joint ventures could again be of three types. Okay, standard says they could further be classified into three categories, means there are three types in respect of these JVs. What are those? One, we call it as jointly controlled operations. Second could be jointly controlled assets. And third could be jointly controlled entities. Okay. So now, as a next step, we need to understand about these three types. In relation to first two types, the accounting requirement will be different. Particularly if you compare this to third type. Okay, so now why is the understanding of these three types required? Because their accounting will vary accordingly. So no, their accounting will vary accordingly. Okay, so let's try to now understand about jointly controlled operations. Yeah. All right. So now moving on to, all right. So I can see this query coming up. from Shoaib. Shoaib is saying, sir, is there any difference between strategic alliance and joint venture, or are they used interchangeably? See, there can be lots of differences between strategic alliance and joint venture. What are those? What is a strategic alliance? You can say two parties have come together for a purpose. Okay, means there is a strategy behind that. Now, what is the strategy? We don't know. That could vary depending on the purpose because of which they have come together. But every time when two or more parties come together, can we say that it will become a JV? The answer is no. Why? Because till the time they will not have joint control, that strategic alliance cannot be considered to be a JV. Okay. So you can say strategic alliance is a larger term. Strategic alliance is a larger term, in which case, JV is a subset. JV will generally be a strategic alliance, but strategic alliance will not always be a joint venture. Understood? Should I clear on this? Yeah. Okay, great. Okay. Then Anil is saying strategic alliance can be a JV, but every JV cannot be a strategic alliance. I would put it other way around. Every JV will be a strategic alliance, but every strategic alliance will not be a JV. Okay. Yeah. That's how you need to consider this. Now, moving further, now what we will do is we'll talk about jointly controlled operations. So we'll pick up all these types one by one. So let's pick up this first type first. Jointly controlled operations. All right. So let's talk about this. So what is a jointly controlled operation? Now, please remember, a jointly controlled operation is a JV to begin with. Yes or no? To begin with, it's a JV. So please don't forget that whether we are talking about jointly controlled operation or assets or entities, they are all what? Joint ventures. So that means all of these have to meet the criteria of a JV. And what are the criteria of a JV? Two criteria. Contractual arrangement has to be in place, joint control has to be in place. Okay, means jointly controlled operations, jointly controlled assets, jointly controlled entities, they all will meet the two criteria always, contractual arrangement and joint control. Okay, now there is something beyond these two criteria as regards these three entities that we need to talk about right now. Okay, now when it comes to a jointly controlled operations, so you can say it's a kind of collaboration. Collaboration means when two or more parties come together, but they do not create a separate legal entity. Generally, they do not create a separate legal entity. Okay. And what they will do is they will pool various resources. For example, say there are two parties, A and B. So they will come together. A will bring its assets, B will bring its assets. A will make the contribution as and when required, B will make the contribution. Okay. And they will create one venture. This will be unincorporated. Generally, let's suppose that is AB. Any expenses in relation to this business. Okay. So let's suppose they are carrying out a business. Any expenses of this business will be borne by them proportionately. Incomes of this business will be shared by them on a proportionate basis. Output of this business will also be shared by them on a proportionate basis. Means for everything they are sharing together in terms of the resources, in terms of the liabilities. So you can say they have pooled together resources to run a business, and that is for a specified purpose generally. That is what you call as a jointly controlled operations. Now, in that case, when you talk about A and B, now it may happen that A is a running company and B Limited is also a running company. So they have their businesses, but they have come together and they have created, let's suppose, a venture AB, okay, which is in respect of a different business, different from what A is doing and what B is doing. Okay. But they don't create a separate entity for this AB. Yeah. A will bring its own assets, B will bring its own assets. Yeah, there will have a common understanding. Of course, common understanding has to be there. Yeah, joint control has to be there. So all of those things will have to be there. Tomorrow, in respect of the liabilities of AB, so they will share the liabilities. They will meet the expenses. Okay, incomes also they will share. So that's how it will work. That's how it will generally work. Okay, so now what we will do is we'll try to understand this with the help of an example, because I think through this example we should get better clarity as to how this type of jointly controlled operation may come into picture. Okay, so let's look at this example number 4. Yeah, Mr. A is a dealer in titles and marbles. Mr. B is a dealer in building materials. And Mr. C is a promoter. So three of them, they enter into a JV business. Means they create a JV, a new business they create. Okay. Now, in respect of this business, any contract for construction received will be completed jointly. Okay, so in this JV business, if any construction contract is received, so what will happen? It will not happen that A will work on this or B will work on this or C will work on this in an isolated manner. No, they will work on that together, three of them. Okay. Say Mr. A will supply tiles, B will supply other materials from its godown, and C will look after completion of construction. As per the contractual arrangement, they will share any profit or loss in a predetermined ratio. So let's suppose equal is there. But it's not necessary that the profit sharing ratio has to be equal. Okay. So that's not a necessity. None of them are using separate staff or other resources for the JV business. And neither do they maintain a separate account. Everything is recorded in their personal business only. Means separate accounting is not done for this business. Whatever A will do, A will record in its books. Whatever B will do, B will record in its books. So they will work together, but the recording in respect of this business, as around assets, liabilities, incomes, expenses, all of those things will be done by A, B, and C in their own books. Okay. None of them are using separate staff, resources. Everything is recorded in their personal business. Venturer does not maintain separate set of books. Now this is very, very important. A, B, and C do not maintain separate set of books for this business. Yeah, for their own business, they are maintaining books. But we are saying that for this combined business, they are not maintaining separate books. But they record all of those transactions in their own books. any transaction of JV recorded separately is only for internal reporting purposes. Even if they record something for this common business, maybe some internal reporting or some purpose is there, that's why they are doing this. But that will not be done for everything. Now, if let's suppose, now let's try to understand this situation. If let's suppose there's a common business. Okay, let's suppose this is the common business. Now, in this common business, say there are three parts: 1, 2, and 3. Now, this part belongs to A, this part belongs to B, and this part belongs to C. Okay, and there are three financial statements: one that of A, second that of B, third that of C. And if A is recording its part in its financial statements, in its books of accounts, B is recording its part in its books of accounts, C is recording its part in its books of accounts. So do we need any separate set of financial statements for this common business? Tell me, what do you think? Do we need any separate set of financial statements for this common business or this common business venture? What do you think? Do we need? I'm saying, do we need any separate set of financial statements for this common business? The answer is no. Why? Because in relation to this business, everything which is there, that is already getting recorded on a proportionate basis by each and every party in its own books. In its own books. Further, if you look at this business, this is not an entity, this is not a legal entity. So this is only a setup which they have created. Yeah. So Khushi is saying because they are already recording their own assets, liabilities, incomes, expenses in their books, then what is left out? Nothing is left out. Yes or no? Nothing is left out. So that's why there is no further need to record that separately. Okay. Clear on this? Yeah. So now what we will do is we will try to understand with the help of an example as to how this accounting is done by the venturers whenever there is a jointly controlled operation. Okay, so we have understood as to what is a jointly controlled operation, but with the help of this example, we will now try to understand its accounting. So let's look at this example. Mr. A, B, C, they entered into a joint venture to purchase a land and then construct and sell flats. So that's going to be the business. Okay. So this will be the business, right? Mr. A purchased a land for 60 lakhs on 1st of January X1, and for the purpose, he took a loan from a bank for rupees 50 lakhs at the rate 8% per annum. Okay, so in a way, the role, responsibility, tasks of A are defined. He also paid registration fees rupees 60,000 on the same day. Mr. B supplied the material for rupees 4,50,000 from his godown, and further he purchased material for 5 lakh for the JV. Okay. Mr. C met all other expenses related to advertisement, labor, other incidental expenses, okay, which were amounting to 9 lakh. Okay. Now, on 30th June X1, means 6 months later, after the purchase of land, each of the venturer agreed to take away one flat each to be valued at rupees 10 lakh each flat. Okay, so what has been agreed that all three will take one flat. So they will construct and sell flats, and out of those flats, one flat will be taken by all three. To be valued at rupees 10 lakh. And what will be the valuation of that flat? Rupees 10 lakh. And the remaining flats were sold by them as follows. Mr. A sold the flats for rupees 40 lakhs. So we don't know the number. Okay, so the total value received from sale was 40 lakhs by A, 20 lakhs by B, 10 lakhs by C. Okay, so all in all, what is the amount which they have collected from the sale of flats? Can you tell me? What is the total amount which they have collected from the sale of flats? Quickly, over to you. Yes. What is the total amount which they have collected from the sale of flats? Over to you quickly. Tell me. Great. Mallu says 70 lakhs. Very good. Kushi is saying 79 lakhs. So how did you get 79? So I think it is 40 plus 20 plus 10, right? 70. Loan was repaid on the same day by Mr. A. So if you remember, A had purchased land and for which a loan was taken. So A has repaid the loan along with interest, and the net proceeds were shared by the partners equally. You are required to prepare two things. One, draft consolidated profit and loss account. Now, this is very, very important to be understood. A wording has been used called as a draft. Now, what do you mean by draft? Draft means which is a kind of memorandum, okay, which is more of prepared for working purposes only. Now, this is a case of jointly controlled operation. Yes or no? So, this is a case of jointly controlled operation. Correct? Yeah. In this case, in this case, do we need to prepare any separate set of financial statements for the joint operation? Means, do we need to prepare the balance sheet, profit and loss for this common business? Tell me, do we need to prepare that? What do you think? Do we need to prepare that? The answer is no. Anil says no. But still, because some workings is required, that's why that's why the requirement is that prepare that draft consolidated P&L, means combined P&L of this business. Further, it says you are also required to prepare JV account in the books of venture. Now, what does it mean? When A will record this, so how A will record the share of the JV? How B will record the share of the JV? How C will record the share of the JV? So in the books of A, B, and C, record the account of the joint venture. Understood? Yeah. So effectively, we are required to do two types of things. Okay. One is the consolidated profit and loss account. Second, accounting in the books of A, B, and C in respect of JV. Okay. So now, as a first step, so what do you do? As a first step, we will move on to the preparation of consolidated profit and loss. Yeah. So that is quite easy to be prepared. Yeah. All right. So now you can also do this alongside, and you can just start sharing your profit or loss in the consolidated profit and loss account if you have done that. Okay. Now, in the profit and loss account, now this is the console one. What do we have? There will be a sale. There will be a sale. So this sale of flat is recorded by A, B, and C. 70 lakhs. Okay. Further, the flats which are taken by the venturers, if you look at it from the perspective of business, that is also a kind of sale. So each of them have taken a flat for 10 lakhs. Okay. So all in all, what is the total value of output which they have sold, whether it is sold to the venturers or to outside party? 70 lakhs plus 30 lakhs. All in all, it is 1 crore. Yes or no? All in all, it is 1 crore. Correct? Now, further, if you look at the question, it says A purchased the land for 60 lakhs. So you'll record this cost. So the cost of the land. So cost of the land you will record. Then registration fees of rupees 60,000 was paid. So that also will be recorded. B brought in material 4,50,000 from his account and 5 lakh he had to purchase. So whether he is bringing from his account or from outside, it's one and the same thing for the JV business. Yeah. So material was spent amounting to 9,50,000. Other expenses incurred by C were 9 lakh. Okay. Then A had taken a loan of 50 lakhs. Of 50 lakhs on which 8% interest is paid. So what is going to be the amount of interest? Can you just compute it and let me know? On 50 lakhs, if you compute 8%, but please remember for half year. Why? Because this all settlement was done on 30th June. So for half year, 50 lakhs at the rate 8% for half year. What will be the amount of interest? What will be the amount of interest? 2 lakhs. Correct? Malu has computed this 2 lakhs. So this will also go to the P&L. Now what is left out? So the balance amount will be what? Profit or the loss? So are we getting profit or the loss? Over to you quickly. Are we getting profit or loss? In this example, profit. Anil is saying we are getting profit. Okay. So now this profit of 18,90,000, which is the balancing figure, this will be distributed amongst all the venturers in equal ratio. If the ratio is not specified, so what will you do? You will consider that to be equal always. Yeah. So every time if the ratio is not given, consider that to be equal. Okay. Now this is divided amongst A, B and C in equal ratio. Done? Yeah. Okay. Now as a next step, what do we need to do? Now we'll pick up the books of A, B and C and record these transactions in their books. So in the books of A, what will happen? A will record all of these entries. A will record all of these entries. So at the first place, what will A do? At the first place, what will A do? A will say there is a bank loan. So a loan has been taken. Okay, 50 lakhs. Okay. Now utilizing that 50 lakhs, land is purchased. But over and above that, 10 lakhs was also required. Why? Because the land was for 60 lakhs and the loan amount was 50. So therefore, what will happen? Bank will also get credited. Yeah. So 10 lakhs will be the amount spent from the bank. Now, will A record the land in its books? No. Why? Because the land which was purchased, that belongs to JV. And that is already consumed over there. Yeah. Then A paid the registration fees. So A will say to bank. A also paid the interest to bank 2 lakh. Okay. Then Whatever flats A has sold, that collection will come to A by bank 40 lakhs. And A has also received one land and building, one flat with a valuation of 10 lakhs. So that will also get credited to the account of A. Okay. Further, what will happen? Further, what will happen? The balancing figure will have to compute. But before that, I think A has also received a profit from the JV. So let's record this profit from the JV. Okay. Now what you should do is you should stop here. You will not close the account of A. Why? Because eventually they have to settle. If you read the line in the question, okay, so if you read this line of the question, net proceeds were shared by the partners equally. So it could be about the profits as well as about the settlement. Means after sharing the profits, if there is any shortfall in cash or excess in cash, so that has to be settled. Okay. Now let's try to understand that. Okay. So what we will do is we'll now leave these two accounting entries. We'll leave these two accounting entries and we'll come to these slightly later. Okay. So now let's look at the books of B. So B has received sale amount of 20 lakhs, land and building worth 10. B has spent on material 450 and B has also paid for material 5 lakhs. Profit from the business was generated equivalent to 630. So now B has an excess cash. B has an excess cash. So that's why this excess cash will go to whom? This will go to A. Why? Because A is getting shortage of cash. So if there will be a shortage of cash, where will that come from? B only. Yeah. So this excess cash will go to A. Okay. Now let's close the books of C. Let's close the books of C. We are talking about closing the books of C in respect of JV account only. Okay. Now C has also received collection from sale of land 10 lakhs. Land and building means the flat valuing 10 lakhs. C also incurred an amount of 9 lakhs on various expenses. C also generated profit from the business 6 lakhs 30,000. So C is also getting some excess cash. So this excess cash should again go to whom? The party which is getting a shortage. Okay. So the moment you do this, what will happen? Account of A will also get tallied. Account of A will also get tallied. So that's how you will close this. Yeah. Anil is asking, sir, it has to be written in contractual agreement uh, regarding the right regarding donation. See, it's not a donation. So it's a, you can say, a contribution amongst each other. Okay. So let's suppose a business is being run. So let's suppose there are three partners. Yeah. And they are into a business and they are saying, okay, today I'll spend more. Maybe tomorrow, whatever you are left with, I'll take it from you. So that's how this arrangement is going on. Okay. Yeah. So they are working together. And at the end, if one partner has spent more, so he'll take that from the other partner. So that's how it works. Okay. Clear? Anil, clear on this? Yeah. Clear? Malu is asking, sir, in this case, how the profit will be distributed equally? See, if you look at the P&L, in the P&L, see this, they have this distribution of profit amongst themselves equally. Okay, that's how this distribution has been done. Fine. Clear on this? Malu, clear? Yeah. See, their invested amount was different, but at the same time, whatever the business has generated, they have not contributed anything in addition. All of three have drawn the same profit. Yeah. And if somebody was getting excess cash, other was getting shortage, so they have shared amongst each other. Okay. Clear? Okay, Malu is clear. All right, great. So now moving on to the next type. Next type means now we will talk about the other type of JV. And what is that? Jointly controlled assets. Okay. Now, what is a jointly controlled asset, or what is this venture? See, this venture is again similar to what you see in case of JCO. Means in this case, again, a separate legal entity is not created. So here again, you do not have a separate legal entity. But how is this different from JCO? In this case, what may happen is, say there are two venturers. They own assets. Okay. Now they will bring together their assets. They will bring together their assets. And those assets will be collectively used for running the business. As around those assets which they will bring in, each party will own its own assets. There will not be a common control over the assets which they bring in. No. So if A brings in asset 1, so asset 1 will be owned by A. If B brings in asset 2, asset 2 will be owned by B. So it will not happen that asset 1 and 2 are now commonly controlled by A and B. No, because they are pulling together the assets. It's more about that. It's more dominant in that. Other than that, as regards the expenses, incomes, okay, output, etc. from the business, that will be shared by them in their ratios, which will be agreed. Okay. Now, let's try to look at one example around this through which we should get more clarity as to how this JCA works or jointly controlled associate works. Okay. And then what we will do is we will also try to understand the differences between jointly controlled operations and jointly controlled assets, because there is a lot of confusion as amongst these two. Okay. So first of all, let's look at this example. ABC Limited, BP Limited, and HP Limited, having the same point of oil refinery and same place of customers, agreed to spread a pipeline from their unit to customers jointly. They agreed to share the expenditure on the pipeline construction and the maintenance in the ratio of 3:3:4. And the time allotted to use the pipeline was also agreed, whatever was the ratio. Now, for this joint venture, each venturer will record his share of assets. Okay. And any expenditure income which is generated, that will also be shared. Now, let's try to understand about this. See, what is the dominant part in case of jointly controlled assets? Let's suppose there are three companies. Huh? Okay, let's suppose there is IOCL, Indian Oil, BPCL, Bharat Petroleum, HPCL. Okay. Now, what do they need to do? They need to move the petroleum from their refineries. So they have the refineries to the location of the customer. So let's suppose there are various locations of the customers. So these are the various locations of the customers. Okay. And what do they need to do? They share a common point of the refinery. So let's suppose they have this refinery. Okay. Now this refinery is an asset for them. So this is lying at a common point. Now from this common point, because the oil, the petroleum has to move to the customer's place. So that's why what do you need? You need one pipeline. Okay. So we are talking about this pipeline right now. Now what they will do is they own this pipeline. They jointly own this pipeline. And they are now trying to pull together this pipeline. So how will they pull this pipeline together? Because from this pipeline, the oil that will get transferred will not only belong to this or this or this, that will belong to all of them. Yeah. But the time has been agreed. So maybe it's been agreed that 10 a.m. to say 2 p.m. this pipeline will be used by this party. And then further for, so there are times of, which are allocated. Okay, so that's how this mechanism really works. So in this mechanism of jointly controlled of assets, what is the dominant part? The dominant part is about this asset. Okay, because of which this JV is getting created. Unlike what you see in case of jointly controlled operations. In case of jointly controlled operations, the dominant part is not any particular asset. Okay, so that's the difference between these two. Yeah. So let's now try to understand the differences. And then we'll look at the accounting requirement as well. Okay. In JCO, venturers use their own assets for the JV business. But in JCA, they jointly own the assets. That's the significant difference or the most important difference. Further, JCO is an arrangement to jointly carry on the operations to earn income, whereas JCA is an arrangement to jointly construct, maintain an asset which will generate the revenue. Clear? Under JCO, all expenses and revenues are shared at an agreed ratio. In JCA, only the expenses on joint assets are shared at agreed ratio. Why? Because remaining things don't belong to the JCO anyways. The remaining things will belong to the respective venturer. Yes or no? Yeah. Okay. So are you clear in terms of what is a JCO, what is a JCA? Yeah. And the differences between these two? Then we'll get on to their accounting requirement also. So now we will get on to their accounting requirement, means the accounting requirement of jointly controlled asset. But if you have any questions, any doubts around this, please let me know quickly. Over to you quickly. Yes. Any questions? No? Everyone clear on this? Okay. Malu is saying yes, clear. Great. All right. So let's look at this example number 2. A, B, C decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. Okay. For the purpose, following expenditure was incurred by them. Building rupees 12 lakh to be depreciated at the rate 5% per annum. Pipeline 60 lakhs to be depreciated at 15%. Computer other electronics 3 lakhs. depreciation rate 40%. Vehicles 9 lakh depreciated at 20%. They also decided to equally bear the total expenditure incurred on the maintenance of the pipeline that comes to rupees 6 lakhs each year. Okay. You are required to show consolidated balance sheet and the extract of statement of profit and loss and the balance sheet of each venture. Now, in this case again, so what are you required to do? In this case, again, the accounting will be done by the respective venturer in respect of the JV. Okay. So you are required to show P&L, but the extract. Why? Because entire P&L of the venture you can't create. You don't know all the transactions of venture. So extract. Similarly, extract of balance sheet of each venture. But before that, you are also required to draft the consolidated balance sheet of the JV. Okay, of the JV. Okay. So what we will do is, to begin with, we will put together this consolidated balance sheet of JV. Okay. So we'll try to create this consolidated balance sheet of JV first. Okay. Yeah. So now, in respect of JV, what do we have? So we have share capital first and corresponding to that assets. Now share capital is what? Now in respect of the share capital, what do we have? A, B and C. They have contributed some share capital. Yeah. And then in respect of the assets, there are various assets. Land and building is there. Okay. Which is the number after depreciation. Plant and machinery, computers. Okay. Then we have vehicles. Okay. Now, I think the better approach to get onto this consolidated balance sheet will be wherein we can just first of all draft the balance sheet and P&L of the JV, sorry, venture. And from there, we can pick up all of these items and put together that in the consolidated balance sheet. Okay. So now that is also a kind of working for the preparation of consolidated balance sheet. Fine. So now in the books of A Limited, so let's begin with the books of A Limited. Extract of P&L. Let's try to get on to the extract of P&L. So there will be an expenditure. So an expenditure will be recorded, depreciation and other operating expenses. Now what are the other operating expenses? They are bearing 6 lakhs per annum, each party. So 2 lakh will belong to A. Okay. And if you look at the notes to accounts, so there will be a building. There will be a building, correct? Okay. And in respect of building, what is the value? 12 lakh divided by 3. So the bill value of the building will be 12 lakh divided by 3. Okay. Now on this 12 lakh, what is the amount of depreciation? 5%. But if you are recording that at 4 lakh, what is the proportionate amount of depreciation? On 4 lakh, if you compute 5%, what do you get? 20,000. 5% will be the depreciation. So 20,000, correct? Okay, so 20,000 you will post here. Okay. Then the next asset is pipeline, plant and machinery. So the proportionate amount will be 60 lakhs divided by 3. 60 lakhs divided by 3, correct? Now, if you compute this 20 lakhs, on this 20 lakhs, what is the amount of depreciation at the rate 15%? If you compute the depreciation at the rate 15%, what do you get? 3 lakh, right? So 3 lakh also is posted over here. Yeah. Then you have computers for 3 lakhs. So the proportionate share is 1 lakh. on which if you charge depreciation at the rate 40%, what do you get? 40,000. Okay. Then vehicles 9 lakh, proportionate amount 3 lakh, on which you charge depreciation at the rate 20%, so you get 60,000. Okay, so all in all, what is the total amount of assets that you have? 23 lakh 80,000. Yeah. So this you will take to the face of the balance sheet also. So this will go to the face of the balance sheet. And this depreciation, I think you can just compute from all of these totals, 4 lakh 20,000, which anyways is available in the form of this working also, which we have just computed. Correct? Yeah. Now, this is the extract of the P&L and the balance sheet of A. So similarly, we can prepare this for B. Yes or no? Similarly, we can prepare this for B. Yeah. For B, do you think the balance sheet extract will be any different? What do you think? For B, do you think the balance sheet extract will have any different number? Just think about it logically. Yeah. Looking at the fact pattern which is given, do you think the balance sheet abstract for B will be any different? Malu says no. Very good. Yeah. So if you look at B, for B, the balance sheet extract, the P&L extract will be exactly same. Why? Because each and everything is shared by them in the equal ratio. Yes or no? Yeah. So their balance sheet extract P&L is exactly same. But still, you will be required to present it separately. Okay. Please remember, you will be required to present it separately. Similarly, for C, the balance sheet abstract, the P&L abstract will be exactly same. Will be exactly same. Okay. Now, as a next step, what do you need to do? You need to put together all of these amounts of A, B, and C in the consolidated balance sheet. Yeah. So in the consolidated balance sheet, what do you have? You have assets worth of 23 lakh 80,000. You have, sorry, assets worth of, just a second. Assets worth of, just a second. So what was the value of assets? 23 lakh 80,000. Yeah. So this is the value of assets of one venture. So you will multiply this with 3. Multiply this with 3. Yeah. So if you do that, what do you get? The total value of the asset, 71 lakh 40,000. And corresponding to that, the total value of share capital will also be 71 lakh 40,000. That's how the balance sheet will get tallied. And further, in the notes, what will you do? Earlier, the values of A, B, and C, which we were recorded separately, now you will put it down. You will take the total. Plant and machinery A, B, and C, you will put it down. You will take the total. Yeah. Similarly, for computers, you will do this. Similarly, for vehicles, you will do this. Okay. Clear on this? Everyone clear? Yeah. Everyone clear? Yeah. So I think Malu, Anil, both of them have computed. Very good. Any questions, any doubts if you have so far? Yeah. So I'm just hoping that both these types of arrangements, whether you talk about JCO or JCA, are quite easy in terms of their understanding as well as the accounting requirement. Yes or no? Yeah. Any questions? Any doubts? No? Clear? Malu seems to be clear on this. Anyone else? Anyone else? Any more questions on this? Or any questions so far? No? All right. So what we can do is, I think before we move further, the next type of the joint venture, that is jointly controlled entities, we can take a break. Okay. So we can take a break now. And after the break, we will continue with our discussion on the remaining part of the joint ventures. Plus, we'll also be taking up associates. Okay. So both the things we'll plan to cover after the break. All right. Yeah. So I think Manish, we can take a break now. All right. Hi, welcome back. So let's continue with our discussion. Okay, so now we'll move on to the next type of joint venture. And what is that? Jointly controlled entities. So let us first of all discuss about this structure, and then we'll get on to the accounting requirements of this structure as well. Now, previous two structures means jointly controlled operations, jointly controlled assets that we had discussed. In those two structures, or you can say in those two types, a separate legal entity is not created. Yes or no? And we understood as to why is that so? Because it's more about pooling of resources, or you can say sharing of the jointly owned assets. Yeah. But there is another type of joint venture, in which case a new entity is created. And when I'm saying a new entity means a new separate legal entity is created. So what does it mean? It means that in this entity, the resources which will be brought together by the venturer, whether it's in the form of assets, whether it's in the form of cash, any sort of contribution, all of those resources will be pooled together. And all of those resources will belong to that particular entity and not to the joint venturers. So what does it mean? Means if let's suppose there are two parties A and B. Okay, A and B, they bring in cash, say in a company C Limited. They have also contributed some assets to C Limited. So tomorrow, all of those cash, assets, etc., they belong to whom? C Limited. Yeah, they belong to whom? C Limited. Any profits or losses which are generated by C Limited through its business will of course be paid to A as well as B in their profit sharing ratio. But as regards those assets or any other resources which are pooled together, over that, the ownership of A and B will be the one which is that of the shareholder. Means tomorrow if A wants that I want to take my cash back, can I do that? The answer is no. Why? Because the net result of the entity, the net residual interest of the entity, tomorrow when this entity C Limited gets liquidated, whatever will be left out, that is something which will be distributed to A and B. Unlike what we saw in case of jointly controlled operations and jointly controlled assets, wherein everything which A and B or any venturer contributed, they will take it back, or they were recording that. But now, whatever they have contributed belongs to this company C. Okay. And because it belongs to company C, so that's why this company C will also be preparing its own set of books. Yes or no? Why? Because it's a company. So the company will have to prepare its own set of books. Yeah. And in this case, A as well as B, in addition to their own set of financial statements, will also be required to prepare consolidated financial statements. Okay. And the method of consolidation which they will use, the basis of consolidation which they will follow, that is called as proportionate consolidation method. Okay, that is called as proportionate consolidation method. So let's try to look at some examples around it. Fine. Now in this case, for jointly controlled entities, say A and B are two infrastructure companies operating in a city A. Local authority has issued a tender to construct a metro stretch for rupees 2000 crore and invited bids to apply for the tender. Okay. A Limited, B Limited jointly form a new company, AB Limited, that will bid for this tender. All the machinery, equipment required will be the responsibility of whom? A Limited. Means A will take care of that. But will A bring that? No. AB Limited will bring that. A is more of a manager of AB Limited. All funding will be managed, controlled by B Limited. But who will bring the funds? AB Limited for this tender. Revenue and operating expenses will be shared jointly by A Limited and B Limited. Of course. Yeah. Yeah. So this is what you see in case of jointly controlled entity. You can say it's an example of jointly controlled entity. Now, what we will do is, we will now pick up one example. And in this example, we will try to get on to the consolidated financial statements. Okay. So let's move further on this example. Through this, we will try to understand the accounting requirements in case of jointly controlled entities. Okay. In case of jointly controlled entities. Fine. All right. So now moving further. So we are given this financial information. I think this is the trial balance. Okay. So A Limited is a UK based company. It entered into a JV with B Limited in India, wherein B Limited will import goods manufactured by A on account of joint venture and sell them in India. Okay. A Limited and B Limited agreed to share the expenses as well as the revenues in the ratio of 5:4 respectively. But the profits, so if the profits are there, they will be distributed equally, means 1:1. A Limited invested 49% of the total capital, but has equal share in all the assets. Now, please remember, this ratio or sharing ratio for profits could be different, revenue could be different, expenses could be different, assets could be different, liabilities could be different. So you should not get confused with that. Okay. Important thing is that for a JV to be in place, two conditions are required: joint control and contractual arrangement. Yeah. So don't think that why there are so many ratios or why the ratios are different. It is possible. Okay. A Limited invested 49% of the total capital, but has equal share in all the assets and is equally liable for all the liabilities of the joint venture. Following is the trial balance of joint venture. So this joint venture is preparing its own trial balance. Of course, that will be required. Now we are not given the name of the joint venture. So we'll keep calling it as JV. Okay. Purchases, other expenses, sales, PPE, current assets. Yeah. So assets, liabilities, all of this information is available. Closing inventory was valued at 1 lakh. You are required to prepare consolidated financial statements. Okay. Now, let's move on to the consolidated profit and loss account, first of all. Now, what do we have? In the P&L, sales 13 lakh 5,000. Yeah. So this will plot 13 lakh 5,000. Then expenses are there, purchases, other expenses. So purchases 9 lakh, other expenses 3 lakh 6,000. So that also will plot. Okay. Then closing stock is given, opening stock is not given. So we'll assume opening stock to be 0. So the inventory has increased. So there's an increase in inventory. So change in stock will also go to P&L 1 lakh. So the total expenses are 11 lakh 6,000. So therefore, profit before tax is 1 lakh 99,000. Yeah. So this is the P&L of the JV. Now please understand, when you are given this P&L, sorry, financial statements which you have been asked for, so this is more about the JV. Okay. So in the question, they are actually asking you for the financial statements of the JV. Understood? Yeah. Okay. Now let's look at the balance sheet. Now, where do you pick this balance sheet from? This will again be picked up from the information in the trial balance only. So you have share capital. Yeah. Reserve and surplus will come from the P&L. Long-term borrowings, unsecured loans, current liabilities, correct? Then you are given some PPE and current assets. PPE and current assets. Inventory. Okay. Now for all of these, what do you need to do? You need to prepare the notes. Now in the notes, what do you have? In the notes, what will you have? In the notes, all of these amounts, whether it is in respect of P&L or it is in respect of balance sheet, you will have to allocate amongst A and B. Okay. Now, as regards sales, what is the ratio? As regards sale, what is the ratio? In which ratio you will divide the sales? Tell me quickly. In which ratio you will allocate the sales? Over to you quickly. What is the ratio for allocation of sales amongst A and B? Over to you. Great. Malu says 5 is to 4. So that's why this 13 lakh 5,000 which you have taken to the P&L, this you will allocate amongst A and B in the ratio of 5 is to 4. Right? Then we are also told that expenses will also be allocated in the ratio of 5 is to 4. Correct? So purchases, other expenses. Okay. So this again you will allocate in the ratio of 5 is to 4. Change in stock. So this is arising due to change in inventory. So inventory belongs to the assets. So that is allocated equally. So therefore you will allocate this equally to both of them. Yeah. Then you have share capital. Okay. Now share capital, we are given 49% is contributed. So out of the total share capital, 49% is contributed by A, remaining by B. Correct? Now P&L, whatever profit is generated, that is equally distributed to A and B. So this is also fine. Yeah. Loans, liabilities, property, plant and equipment, all of these assets and liabilities, you need to allocate that on an equal basis. Why? Because that is what the question asks you. Yeah. And that's it. With this, you are done. Okay. So in this question, what is it that you are actually required to present? Basically, two things. One, you need to convert the information of trial balance into the financial statements in the appropriate format. Number two, you need to allocate those numbers which belong to the JV amongst the venturers in their ratios. Amongst the venturers in their ratios. So these are the two things you are required to do. That's it. Okay. Everyone clear? Any questions on this? Tell me quickly. Any questions on this? No? Everyone clear? Yeah? Okay. So now in this question, the requirement was to prepare the financial statements of JV. But we have also discussed that whenever it will be a case of jointly controlled entity, so the venturers, means the investors, will also prepare consolidated financial statements. Okay. And when they prepare consolidated financial statements, what methodology they will use for consolidation? Proportionate consolidation, which is somewhat similar to what you follow in case of subsidiary. Means all the assets, all the liabilities, all the items of P&L you will pick up. But instead of picking up all of them on 100% basis, you will pick that in the consolidated financial statements of the investor on a proportionate basis. So that is something we'll try to understand with the help of this example now. Okay. Yeah. All right. So let's look at this example. A Limited entered into a JV with B Limited on 1:1 basis. So what do you mean by 1:1 basis? Equal proportion. Means equal proportion. And for this JV, a new company was created. C Limited. So C Limited is what? JV. A Limited is what? Venturer. B Limited is what? Venturer. Okay. So we are also given balance sheet of all the three companies. Okay. Balance sheet of A Limited means own financial statements of A, own financial statements of B are given. What are we required to prepare? We are required to prepare consolidated financial statements of A as well as B. Yes or no? So their standalone are available, their consolidated are required. Understood? Yeah. So everyone clear on the question? Yes, quickly, please confirm. Yeah. So are you clear on the requirement? So how is this requirement different from the question we just covered? See, in the previous question, you were required to prepare financial statements of the JV. In this question, financial statement, in a way, balance sheet of the JV is given to you. And balance sheet of the venturers are also given to you. You are now required to consolidate this set. Okay, this set. But can you consolidate this on 100% basis? The answer is no. Answer is no. So let's try to understand that as to how you'll do that. Okay. Okay. So first, in the question itself, if you are told consolidation method, what does it mean? Means you will prepare CFS. Yeah. And the good thing is what? This method you don't have to think about. Question itself is telling you the method to be followed. Yes or no? So the question in itself is telling you. So you are being told what is the method you need to follow. All right. Yeah. Anil is asking, sir, it is covered under JC and we have to follow JC accounting, right? Yes. See, every time there will be a separate legal entity, that should be a case of JC. And only in case of JC, proportionate consolidation is required. Why? Because please remember, for JCO and JCA, the venturer will record their shares, all of these things in their own financial statements. Now, over and above their own financial statements, venturers are also required to prepare consolidated financial statements. Means A will also prepare consolidated financial statements, B will also prepare consolidated financial statements. It is similar to what you see in case of holding and subsidiary. Okay. Similar to what you see in case of holding and subsidiary. Clear? Now clear? Yeah? Anil, clear on this? All right. So now let's move on to the balance sheet of A Limited. So first of all, we will start with the information of A Limited first. Means when you will prepare console balance sheet of A Limited, so of course we will pick up its standalone. Yeah. In the standalone, you will then merge the part of C Limited which belongs to A. Okay. But please remember that in the financial statements of A Limited, you will not merge any portion of B. Okay. So that mistake you should not do. Understood? Yeah. So now to begin with, we have the share capital of A, 10 lakhs. So that we can put down. Then we have reserves and surplus. So let's move on to the notes. I think in the notes, everything is clarified. So for A, reserves are given 18 lakhs and you will pick up 50% reserves of C. 50% reserves of C. For A, loans are 3 lakhs. You will pick up 50% of C. For A, current liabilities are 4 lakh. You will pick up 50% of C. For A, property, plant and equipment is 30 lakh 50,000. You will pick up 50% of C. For A, current assets are 2 lakh and you will pick up 50% of C. Okay. Yeah. So if you do that, in this case, there are two things you have missed out on, or you can say you have skipped. Let's understand that. Will you pick up this share capital of C Limited in A? The answer is no. Why? Because 50% of capital of C Limited belongs to whom? A. Yes or no? 50% capital of C Limited belongs to whom? A. Correct? And this 50% capital of C Limited, which belongs to A, is represented by what? This investment in the books of A. Yeah. This is represented by investment in the books of A. So that's why you will say that when these two are getting merged, okay, so in a way, what are you doing? You are considering A and C to be one entity and consolidating them. So when you will consolidate them, any intercompany transaction between these two, you will eliminate. So if A has invested in C, so that's a transaction between A and C. That is something you'll have to eliminate. So the investment of A, which is the share capital of C, they will get knocked off. Investment of A and share capital of C, they will get knocked off. Pick up the investment of A, nor you will pick up the share capital of C. Can you see this? Yeah. And your balance sheet is ready. And your balance sheet is ready. Clear? Everyone clear on this? Yeah. Anil is saying, yes, sir, will not pick up this because we are already considering the assets portion. So it's not that we are already considering the asset portion. It's because investment of A, which is in C, that will knock off the capital. This is exactly similar to what you do in case of holding and subsidiary. Remember AS21? In AS21 also you do the same thing. Yeah. In that case, the only difference is you pick up 100%. But now you're not picking up 100%. You will pick up only the proportionate share. Okay. You'll pick up only the proportionate share. Fine. Okay. Now, moving further. Now, as a next step, we will move on to the balance sheet of B. I think that is also quite similar. Yeah. So now for the balance sheet of B, there again, what do you do? Same thing you'll have to follow. Same approach you'll have to follow. So I think for B, there again we can look at the notes first. So B's reserves are what? 16 lakh. And the proportionate share of C, 6 lakhs. Now you will find out that reserves of C you have distributed. Why? 50% you have given to A and 50% you have given to B. Yes or no? Yes or no? Okay. Similarly, loan of B was what? 4 lakh. Proportionate share of loan of C, 1 lakh. Current liabilities of A given in the balance sheet of, current liabilities of B given in the balance sheet of B. Proportionate share of B in C in the current liability, 50,000. PPE of B, 26 lakhs 25,000. Where do you get this from? In the balance sheet of B and the proportionate share of C. Yeah. So similarly, you will pick up the proportionate items of current assets. Now, here again, if you look at the balance sheet of B, in this case, only the share capital of B has been picked up. Can you tell me why the share capital of C has not been picked up in this balance sheet once again? Yes, over to you quickly. Can you tell me why the share capital of C has not been picked up by us? What is the rationale? Why that has not been picked up by us? Over to you. Quickly. What is the rationale? Why do you think the share capital of C has not been picked up by us? Kushi is saying because B's part of capital is shown as investment in the books of B, and these two will get knocked off. In fact, the amounts are also matching. So if you go look at the balance sheet in the question, okay, so let me just take you to the question. 50% of capital C is what? 2,50,000. 2,50,000 is the investment by A as well as B. So they are getting knocked off. Yes or no? And it has to get knocked off. Only if it will get knocked off, the balance sheet will tally. Otherwise, when you prepare the consolidated balance sheet of A and B, will they tally? The answer is no. Okay, because for every debit, there has to be a credit. For every asset, there has to be a liability. Yes or no? Yes or no? Everyone clear? Yeah, so you're clear as to how you prepare the consolidated balance sheet or the consolidated financial statements, and what is this proportionate consolidation that you are required to follow. Okay. Yeah. All right. So now there's one more point we can just quickly look at. See, if you remember, we discussed, we talked about any intercompany transaction. Okay. And we talked about that if there is any transaction within the company, means if there are transactions within the branches, within the units of the same company. So we don't record that in the financial statements. Yeah. Similarly, when we discussed holding and subsidiary companies, the consolidation under AS 21, there again we discussed that if there is any transaction between the group companies which you are consolidating in the group, so any transaction between those group companies you will have to eliminate. Yeah. Now, the same principle you need to follow here. See here again, are you not doing the same thing? Yes, you are doing the same thing. So what is the same thing that you are doing here? Here again, there is a venture and there is a JV. And these two companies, if they are transacting with each other, then the part of this JV which belongs to the venturer, so that is also a kind of intercompany transaction within the group. because there are two companies within the group which are getting consolidated. So you should apply the same approach in this case. That is, you should eliminate such intercompany transaction. But you'll not eliminate that fully. Why? Because only the portion of this JV belongs to venturer. Yeah, the remaining portion of this JV which belongs to other investors, that you will not eliminate. Yeah, yeah. So the same principle you are required to consider here. So let's try to apply this. Okay. So we have this small example to discuss this. A and B established a separate vehicle, entity J, wherein each operator, so it seems to be a case of jointly controlled operation. But does it matter to us? No. Why? Because JV is a JV. Whether that is JCO, JCA, or JV, that's one and the same thing. Okay. Each operator has 50% share. 50% output is taken up by each operator. Means their ownership is 50%. Whatever output will be generated, they will pick up 50%. Is it possible to have these two ratios different? Yes, it's possible. That depends on the contractual arrangement between these two parties. On the formation of the joint venture, A contributed a property with fair value of rupees 110 crore. Okay, so A and B will contribute their assets. So A brought one property which had a fair value of 110 crore and agreed to contribute his experience over the years. So A said, okay, I'll bring in a property and I'll also work together. Okay, so whatever experience I'll have, I'll keep sharing in respect of the business. B contributed equipment. So B bring in one equipment with a fair value of 120 crore. Okay. Now, the carrying values of the assets which A and B have brought are 100 crore and 80 crore. Means the property which A has brought had a book value of 100 crore. Equipment which B has brought had a book value of 80 crore, which is okay. Yeah. Now, let's try to understand the gain in the consolidated financial statements in respect of A. Now, in respect of the property which has been contributed by A, so that's the property which belongs to A, which is owned by A. Okay. So we don't need to look into that. But the equipment which is brought by B, now that will get shared equally by A and B as per the arrangement between them. So that's why what will happen? 50% of this 120 crore will be the share of A. So A therefore will get 60 out of this 120. Okay, in terms of the valuation we are looking. Okay. Now for getting this value of for getting this equipment worth of 60 crore, I'm looking at it only from the perspective of A. What is it that A was required to do? A was required to bring in one property for which the book value was 100 crore. So will A consider its fair value? No, because A will consider the book value, means the asset which he has contributed. What is the book value of that? Its book value was 100 crore. Now, out of this 100 crore, 50% A will lose out. Why? Because this 50% will now go to B. This will now go to B. Yeah. So he loses out 50 crore. So therefore, the total gain which A will recognize will be what? 10 crore. Will be 10 crore. Okay. Clear on this? Yeah. All right. So I think this is it that we had on the joint ventures. Now what we can do is we can just move on to the associates. Okay. So in the previous session, we talked about associates. Okay. So it's not that we didn't discuss associates at all completely, but in respect of associates, we couldn't discuss their accounting requirement. Okay. What all accounting requirement they need to follow. Yeah. So all of that stuff we couldn't cover. Yeah. So what I'll do is I'll now move on to associates, means AS23. And today, what we'll plan to do is we'll also try to cover their accounting requirements. Fine. All right. So now, before we really get on to that, I think it will be good to do a quick recap in terms of our understanding of associates. So even though we have covered, I think let's do a quick recap as to what is an associate, how do you consider an investor to be an associate, okay, for which AS23 of course will apply. Now let me just quickly take you to our understanding of the associate. Now in respect of the associate, what do we understand? That there are two entities. One is the investor. Let's suppose A Limited. And then we have investee. Let's suppose B Limited. So B Limited is what? Investee. Okay, so A has invested in B. And say A holds 25% shares of B. A holds 25% shares of B. So in this case, the shareholding of A is less than 50%. Shareholding of A is less than 50%. Yeah. The moment we say that the shareholding is less than 50%, so can A get control over B Limited? Tell me. Can A get control over B Limited? Over to you quickly. Shoaib says no. Malu says no. Great. If you say the control is not possible, so that means B will not be considered to be a subsidiary of A. A will not be considered to be the holding. Okay. Now, in this case, okay, so Anil has shared a very good response. I'll come to this point, Anil. In this case, if you look at B, someone can say that 75% of shares of B are held by other shareholders. Yes or no? So these are held by other shareholders. Now the problem is we don't know. There could be various other shareholders. But one thing we understand is that between these other shareholders and A, we don't have any contractual arrangement for joint control. We don't have any contractual arrangement for joint control. So therefore, in this case, joint control is missing. If the joint control is missing, so can we apply AS27 that we just discussed? If the joint control is missing, can we apply AS27 that we just discussed? The answer is no. So means AS27 also goes out of the picture. Okay, now let's try to understand one more perspective in this. Okay, which is again very, very important to be looked at. Now, what is that? Standard says that today, if you look at this company B Limited, okay, this B Limited is owned by, let's suppose, two parties, A and other shareholders. And let's suppose these other shareholders have got control. Let's suppose. Let's suppose other shareholders have got control over B Limited. So what will happen? B will become a subsidiary of other shareholders. Yeah. So other shareholders will consolidate that as per AS 21. Let's suppose, okay, we don't know, but let's suppose that is there. Now, because other shareholders will have control, so let's try to understand the situation of B. Say in case of B, there are 5 directors. B has got 5 directors: D1, D2, D3, D4, D5. Yeah. Now, these 4 directors, D1, D2, D3, D4, they belong to whom? Let's suppose these other shareholders. Okay. Now, tomorrow, if any decision in respect of B Limited is required to be made, so what will happen? So, if any decision as regards B Limited is required to be made, so who will have the final say? Can you tell me? Will it be A Limited or other shareholders? Will it be A Limited or other shareholders? Tell me. Tell me. A Limited or other shareholders? Malu Kushi says other shareholders. Great. Now let's suppose that D5, okay, this director D5 belongs to A, belongs to A, means he is representing A Limited. Now in this case, I have the same question for you. Now here again, let's suppose if any decision in respect of B Limited is required to be made. So who will have the final say? Will it be A Limited or other shareholders? With this understanding, what do you think? Will it be B Limited or other shareholders? Quickly, over to you. Considering the fact that D5 is the representative of A Limited, what is going to be your answer? Who will have the final say in the decision making? Shoaib says it will not change. It will still be other shareholders. Kushi, Anil, they have the same answer. Why? Because majority belongs to other shareholders. Correct? So that means final say, if any decision making is required to be made, cannot be with A. But tell me one thing, that let's suppose if the board meeting of this company is going on. Okay, let's suppose B Limited is in the process of carrying out some activities, a board meeting is going on. There are some critical matters which are being discussed. And these 5 directors are sitting over there. Okay, let's suppose D1 is not present. Okay, let's take him out. He is not present. Yeah. Let's suppose D3 is also not present. Still, the majority is with whom? Other shareholders. Yeah. So whether D1, D3 are present or not present, irrespective of the fact, final say as regards the decision to be made, we understand will be with other shareholders. But can we not say that A will at least be able to put across his point? A will not be the final deciding authority. We understand. But can he not participate in the matters? Maybe whatever he suggests is not accepted by the remaining directors. Understood. But as regards his participation, can we not say that his participation is possible? He will be able to participate because of his voting percentage that is available? Anil says yes. He can put pressure. See, he can put pressure or he can only participate. Let's suppose he's not putting pressure, he's only suggesting, he's participating that. Yes or no? So is that participation right available to A Limited or not? Tell me, is that participation right available to A Limited or not? She says yes. So this power to participate that you say, what do you call it as? This is what you call as significant influence. Okay. So this is what you call as significant influence. Okay. So in this case, we will have to say that A limited will have significant influence. A limited will not have control, but A limited will have significant influence over B limited. And the moment we say A will have significant influence over B limited, so what will happen? B limited will be considered to be associate of A, and A limited will be required to prepare consolidated financial statements. So A will prepare its financial statements. Over and above that, A will also prepare consolidated financial statements. Similar to what you do in case of proportionate consolidation, similar to what you do in case of line by line addition in case of holding subsidiary, means CFS A will have to prepare. In addition to its own financial statements, A will also prepare one more financial statements. That is what you call as consolidated financial statements. And the consolidated financial statements which A will prepare. Now the question is what methodology you will follow, what mechanism you will follow. Yeah. So that consolidation is required to be done using equity method of accounting. Equity method of accounting. Okay. Now the question arises that what do you mean by equity method of accounting? Yes or no? Yeah. So now this is very, very simple, easy to understand. So let's move on to this equity method of accounting. Okay. And that is something I think we didn't discuss earlier. So we'll try to cover that now. So what do you mean by equity method of accounting? See, equity for the purposes of this equity method of accounting means net assets of a company. Means net assets of a company. Which means that to begin with, let's suppose today, say on 14th of December 2024, A gets significant influence over B limited. So what will happen? What will happen? Net assets of B limited. Let's suppose if those are 100, it would mean that out of this 100, 25 will belong to A limited. Why? Because 75% belongs to other shareholders. 25% belongs to this investor, A limited. Okay. So this will have to record on the date of acquisition. So what is the date of acquisition? This is the date of acquisition. And let's suppose as against this 25, if A has paid 50 rupees or say 60 rupees or say 100 rupees or say 20 rupees, whatever be the case. So now here again, similar to what you do in case of holding and subsidiary, what will you do? So this is the purchase consideration. So this is the purchase consideration. So this purchase consideration will be compared with the net assets. Net assets means proportionate net assets. So if the purchase consideration will be in excess, then the goodwill will be recorded. If the purchase consideration is short, capital reserve will be recorded. Exactly similar to what we have computed in case of AS20. Okay. Yeah. So we will compute goodwill or capital reserve to begin with. Now, let's suppose on 31st of March 2025. Now B Limited is a company, so it will continue. B Limited is a company, it will continue. Let's suppose its net assets have increased. Say they have become 200. Why? Because the company has earned profits during this period. Yeah, company has earned profits. So now at the year end, in relation to A, what do we need to do? We need to update the value of net assets. So initially, what did you record? 25. Why? Because 25% was the portion of B which belonged to A. So now what you will do is you will have to update this. So this will become 50. This will become 50. So now what A will record is A will record 50. So in its balance sheet, initially A recorded 25. At the year end, A will record 50. And the difference which will get generated will go to the P&L of A. Will go to the P&L of A. So this 50 will sit in the balance sheet of A, and this 25 difference will go to the P&L of A. Okay. Yeah. So I think we can just, Shoaib is asking, sir, is this same as the minority interest? You can say yes. At times, minority interest can be having significant influence, but not always. Okay. Standard says that if shareholding is more than 20%, then it is presumed significant influence will exist. Okay. But not always. Yeah. You'll have to assess that. And the moment I say more than 20%, you also need to understand it has to be less than 50%, of course. Why? Because the moment you cross that 50%, so you'll get into that controlling stake. Okay. So let's look at one example to which I will try to get some more clarity as around this equity method only. Okay. So let's look at this illustration. A Limited acquire 45% of B Limited shares on 1st April 2000 X1. Price paid was 15 lakhs. Okay. Now, what is this price paid? Can you tell me? What do you call this price paid as? Over to you quickly. What do you call this price paid as? Over to you. We just discussed. Very good. Anil is saying purchase consideration. Very, very important. Okay. And this purchase consideration is paid not to get 100% shares of B, but to get 45% shares of B. Okay. So generally in the exam, this is the mistake one can make. Why? Because you can just pick up 100%. 100% don't belong to you. Yeah. So you need to pick up the proportionate part. So that is something you need to remember always. Fine. Yeah. So that 100% you should not pick up. Then we are also given the extract of balance sheet of B Limited as on the date of acquisition. Paid up equity share capital of B is given. B also has got some reserves in the form of free reserves, in the form of security premium. Okay. B Limited has reported net profits of rupees 3 lakhs. Okay. Post acquisition during the year, B has earned profits of rupees 3 lakhs. So why is this important? Because these profits will increase the net assets of B Limited. Yes or no? These profits will increase the net assets of B Limited. Okay. Moving forward. B Limited also paid dividend of rupees 1 lakh for the year ended 31st March 2000 X2. Yeah. Calculate the amount at which investment in B Limited should be shown in the consolidated balance sheet of A Limited as on 31st March X2. Okay, so you are required to print this in the consolidated balance sheet of A Limited. Now, please remember, A Limited is not only required to prepare standalone balance sheet. A Limited is also required to prepare consolidated balance sheet. So that is a very, very important point. Can you quickly move on to this calculation? Yes, can you move on to this calculation? Yeah, in the case, the prime part, the most important part, primarily what to do is you need to get into the calculation of net assets. Yeah, moment you do that, I think your solution part will cover. Okay. Yeah. As on the date acquisition, so can you tell me what is going to be the net assets of B Limited? Over to you. What will be the amount of net assets of B Limited? Over to you, quickly. What will be the amount of net assets of B Limited? Over to you, quickly. Yes, on the date of acquisition. Yes, very good. So I think Malu, Anil, they are saying 16 lakhs. Correct? All right. So let's look at this. Net assets of B will be equity shares plus the reserves, 16 lakhs. And out of these net assets, the proportionate share of net assets which belongs to B will be 45%, 7,20,000. 7,20,000. Okay. Now, to acquire the net assets worth of 7,20,000, B has paid an amount of 15 lakhs. So therefore, what do you get in this case? Goodwill? You get goodwill in this case? Yes or no? Yeah? Okay. So now goodwill we have computed. So now this is very, very important. On the date of acquisition, we'll have to compute this. So on the date of acquisition, what do you get? Goodwill. Right? All right. So now let's move on to the closing date or the reporting date, means year end, 31st March X2. To begin with, share of net assets of A Limited was what? 7,20,000. So this was the balance to begin with. To which, if you add goodwill, you will get the total cost of investment by A Limited in the 45% shares of B Limited. So the cost of investment was what? 15 lakh. So this was the total investment, correct? Now, during the year, if the net assets have increased, so this allocation of increase in net assets will also be taken up by A. Yes or no? So why is net asset increased? Because of profit. So can we say this entire profit belongs to A? Can we say that? Tell me. Can we say that this entire profit belongs to A? The answer is no. Only the proportionate profit belongs to A. So that's why out of this profit of 3 lakh, 45% will be allocated to A. So this will be added to the cost of investment of A. And the dividend which will be distributed by B. So if the dividend is distributed, so the net assets will go down. Net assets will go down. They will get reduced. Yes or no? So there again, this entire dividend has not been paid to A. 1 lakh is the total amount of dividend, out of which 45% is the amount which has been paid to A. Yeah. So this 45% will reduce the proportionate net assets. So what is going to be the total amount of the investment because of this? 15 lakh 90,000. And this 15 lakh 90,000 has got two portions. Can you tell me what are those two portions? This 15 lakh 90,000 has got two portions. So can you tell me what are those two portions? Over to you quickly. Yes, quickly. What are those two portions? Yes, quickly. What are those two portions in respect of this 15 lakh 90,000? One is that of goodwill. Very good. Anil just mentioned one is that of goodwill equivalent to 780. And the balance amount is what? Net worth, or you can say the net assets. Okay. So whenever you are required to present it, you will always have two portions of this cost of investment. One that will be the portion of net assets, and second will be goodwill or capital reserve. Now that will again depend as to whether you are getting goodwill or capital reserve. Okay. Yeah. So I think this is it that we had on the consolidation. Yeah, and we have been able to wrap up all of this. Huh? So any questions, any doubts, if you have, you may just let me know. Otherwise, we are through in terms of what was planned to be covered. Huh? And some of you who don't have any questions, they can just feel free to move. Yeah, so thanks everyone for your time and for this participation you have shown. Thanks so much. Over to your questions, doubts, if any. Yes, if there is any question. All right. So if you don't have any questions, I think we can just close our session. Yeah. Shoaib has a question. So he's asking, sir, do we consolidate all the assets at whole amount or partially? So if you are asking about associate, okay, so in case of associates, you will pick up the share of net assets, the way we just did it. Okay. If you are talking about JV, then you will pick up proportionate. If you will talk about subsidiary, therein you'll pick up 100%. And corresponding to that, you'll have minus. Okay, and he's asking, sir, could you please tell me whether revision class schedule is different and regular class is different? Yes. Yes. So these two are different. And I think there's a schedule which is available. You can just read out to the respective admin team. They will be able to clarify. Otherwise, this I understand is also available on the portal. You can go check. Huh? Okay. Yeah. Done. All right. So thanks everyone. Huh? I think we can just close this discussion. Thanks so much. I think Manish, we can just close this. Thank you.